feel free to join the live Zoom with the link in the comments, and we'll just get this started. Great to be here again. I was just mentioning to Rob, who is our guest speaker tonight, we did another session about a year ago, last August. I think it was mid-August last year, talking about underwriting. So obviously that was based on your previous book, right? And I think we have some exciting news coming up on an upcoming book. So I'd love to turn the floor over to Rob Beardsley. And if you guys don't, what's that? All right, someone was on unmuted there for a second. All right. They just left. Okay, fine. Well, welcome, and Rob, I'd love to turn the floor over to you.
Yes, thank you very much, and great to be with you all tonight. And thanks, Yona, for having me on again. Really excited to have a great conversation. And as Yona mentioned, last time I was on, I talked about underwriting, which is a popular topic for me, and it ties in nicely with my first book that I published a couple years ago now. So it's amazing that it's been 2 years since we published the book. We've sold over 6,000 copies and given away the model thousands of times as well. So that was a really fun experience. And we are finally ready to publish our second book, which is called Structuring and Raising Debt and Equity for Real Estate, which is the topic of today's discussion as well. So it's a topic that I'm really passionate about, and something that I thought writing a book on would be a great way to get all my thoughts down on paper. And it's a really hard topic to write about because there's so many ways to structure a deal from the debt and the equity side, and the blends of both in terms of preferred equity and mezzanine debt. But I think this topic can really create a lot of value. And we focus on finding good deals. And I think finding good deals is really important. And that's what the first book was about. It's about how do you identify a quality opportunity, and by the numbers. Obviously, there's qualitative things that make a deal good, but from the numbers standpoint, underwriting is the key tool that you need to have in your toolkit to be able to actually identify a good deal. But then there's another huge element of the deal making process, which is actually structuring the deal and putting it together. And so the two components that I'd like to touch on tonight are the structuring side of things, which means what type of debt you're using, whether it be a bridge loan or a permanent loan, whether it be a fixed rate or a floating rate. And everyone has their own opinions about this. So there's no necessarily right or wrong answer, but it's interesting to weigh the pros and cons, and every deal is unique, which makes this business so much fun. And then on the raising side, right, that's the structuring side of deciding how do you want to put the deal together. And then the raising side is actually how do you go out and communicate with investors, pitch the deal, raise the money, and actually manage that process, which is a huge factor, huge component of our business, as we all know. So yeah, I think it's a fun, big topic, and really looking forward to publishing the book, which is coming out in about a month. We're actually going to do a soft launch of the book at our event that we're hosting in New York in a month, the LSCNY Summit. So that's going to be a really great opportunity for us to be giving books away and having a soft launch. But then the book will be on Amazon soon thereafter. So yeah, that's kind of enough of the commercial side of things. But so to dive in, and again, also I see just based on the attendees in the Zoom, it looks like there's some people that I recognize that maybe are more experienced. So if there is discussion topics or questions to kind of go dive a level deeper, I'm always happy to do that. So just help me steer the conversation so we can get the most value out of it. I don't know how, I don't know, Yona, how these, I don't remember how these normally run, whether people unmute themselves and chat or if it's more of a presentation, but either way, it's fine for me.
Yeah, we'll play it by ear. I think the floor is kind of open if people do have questions. Happy to have them chime in. You can use the raise the hand thing or just type in a chat, a question in the comments or whatever you want to do, and we'll just kind of keep it flowing.
Perfect. All right, I will monitor the chat as we go along. So to actually get it started, my background is in multifamily. Just a quick introduction on me. I'm the co-founder of Lone Star Capital. We are a 4.5-year-old multifamily owner operator. We're based here in New York City with our operations in Texas, primarily Houston. Almost our entire portfolio is in Houston. And last year we vertically integrated our operations. So we brought property management in-house, which is also can tie into raising equity, believe it or not. We can talk more about that later. With vertically integrated operations, we've been able to scale to acquiring over 300 million in assets, all being workforce housing in Texas. And so when I talk about structuring and raising debt and equity, it's really with a focus on multifamily, which I know is a very popular asset class. And I'm sure most people on the call are at least interested in that asset class as well. So yeah, just understand that that's my experience. That's my background when talking about these different products. So I just want to cover quickly on the debt side, then we can get to the more exciting stuff on the equity. But to give you an overview of the debt world and also maybe a little bit of an update as far as where we're seeing the debt market today, I think that actually might be the most interesting thing that's happening. But to take a step back and just give an overview, the debt market is mainly comprised of short-term loans and long-term loans. And we call short-term loans bridge loans. And the reason why they're called bridge loans is because you typically have a transitional business plan, which involves bridging the asset to stabilization to permanent financing. So bridge loans have become very popular for many reasons, and it's also become a very competitive space on the lender side. And as lenders have competed for that business, that's driven interest rates lower and made the terms more compelling. So a lot of borrowers have been going towards the bridge loan option. The downsides typically of a bridge loan outside of price and potentially more onerous terms is really the short-term nature of it. And even if you are getting a great interest rate on a bridge loan, you still need to recognize the potential downside or the added risk of the short-term nature of the loan. And that's what savvy investors, especially today, really are pushing back on. So, we're doing deals today with bridge loans, we're doing deals today with longer-term debt, and many savvy investors are passing on the deals or choosing to sit on the sidelines because they are worried about the short-term nature of the loan, because that loan may be coming due at a time where the market is weaker or the business plan is still underway. And so it's just better from a risk standpoint to have more time to implement your business plan and to have more time to allow rent growth and appreciation to play out. So that way you have an easier time of refinancing and paying off that loan when it comes due. So that is kind of the last kind of 4 years of the bridge loan world. And then on the permanent side of things, you have primarily Fannie Mae and Freddie Mac loans, which are agency loans, and they're typically 10 years in term. So they really check the box for being long-term debt. I really think that the glory days of doing agency loans, which goes back, I'd say, really pre-pandemic, because once the pandemic hit, cap rates really fell through the basement, and it made it really hard to do permanent loans. And that is because long-term debt or permanent debt is constrained by the in-place income at the property. There's nothing the lender can do to make a loan based on anything but the in-place numbers. And so that limits the lender to a certain loan to value, whereas a bridge lender can look at the potential future value of the property, future income of the property, and make a loan at a greater leverage point because of those things. So when cap rates continue to decline, it really made it hard for agency lenders to compete on leverage. And that's in part the popularity, as I mentioned, of bridge loans. They grew as agency loans decreased in popularity. But going back to kind of the golden age, 3-4 years ago, where agency debt was very common and people were able to get high leverage and the 10-year term, it really was a Goldilocks period for multifamily, because your cap rate was, let's say, 5%. Your interest rate was somewhere in the 3s. So you got positive leverage day one. And because of the 10-year term, you had very low risk. It's almost as if you couldn't lose. And then the fundamentals were so strong. So I think we have all done well And we've been successful with bridge loans, right? When your business plan works out, you do really well because the added leverage really amplifies the returns. And we've certainly have benefited from that. And we've seen lots of other people sell deals and have crazy IRRs back to their investors. And bridge loans help with that. But then you have to look at the downside risk of, getting caught in a situation where you can't exit when you want, and you have to maybe refi and you have to delay the project. And that's really just what I want to emphasize is the downside nature of a long-term loan. So both products are a good fit for the right deal. So that, just because I kind of went back and forth, it doesn't mean we don't like bridge loans. As I mentioned, we're doing loans that are short-term and long-term at the same time today. With that being said, I think there's both deals, strategies, and periods of time in the market cycle that are more appropriate for each strategy. So just keep that in mind. The other thing that's often a major differentiator between these two types of debt structures is the fixed rate or floating rate nature of the interest rate. So most typically, bridge loans are floating rate loans, whereas most permanent loans are 10-year loans. Are fixed rate loans, and they're also 10-year loans. And so the reason for that is many people who are locking in a 10-year loan, they don't really want to take interest rate risk. They want to be able to sleep at night. They want to lock the rate and forget about it. There's already so many variables in real estate investing. And so for many investors, they don't want to add on another variable, being interest expense, to their pro forma. So as a long-term investor, many choose to lock the rate. And then on the bridge loan side, most people are okay with the floating rate on the bridge loan because they don't anticipate being in the loan for very long. If you're in the loan for 3 years, really your goal is to get in and get out anyway and make your money on the differential between your buy and sell. We call it the buy-sell spread, or just your buy-sell. And your cash flow, maybe it goes up, maybe it goes down based on interest rate, but that's not the major factor that is driving your returns. So you're not as concerned about your floating interest rate risk on the bridge loan side. With that being said, there are actually ways and lenders out there that provide the opposite. There are lenders that provide fixed rate bridge loans, and there are lenders that provide floating rate permanent loans. And this just adds to the variety and the interesting nature of different ways you can structure a deal. So it is quite interesting today when everyone is worried about rising rates, and we've already been experiencing the trouble with rising rates. And so a lot of people are moving towards fixed rates if they weren't already in fixed rates. So we are, for example, doing a bridge loan right now with a fixed rate loan. And so that really helps give investors confidence in the deal because, again, it's one less variable they have to work with, and rising interest rates are already on the top of everyone's mind. So it's a great selling point to be able to find that fixed rate bridge loan product. If the other interesting wrinkle about the market today is the rise in prominence of bank debt. So traditional bridge lenders, which I would call traditional bridge lenders CRE CLO lenders, but that stands for commercial real estate collateralized loan obligation. And so most bridge lenders, their back end execution is essentially selling the debt in pieces as bonds. And that's what allows them to get the lowest, to be able to provide the lowest interest rate because their cost of capital is so low in the bond market. So those bridge lenders stole the market. They were providing all this cheap debt and they were taking up all the market share. And it was only until recently to where the bond market and the CRE CLO market became dislocated that those lenders really were no longer able to be competitive on price and terms. And they backed down on leverage. Their pricing went way up because of the uncertainty at which they could sell the bonds at. And banks really have now stepped up and filled that gap. Now, banks haven't stepped up and filled the gap back to where the CLO lenders were at in their peak in terms of the attractiveness of their leverage and their pricing, but it's still really doing very well. And it's something that we've pivoted to as well. So for example, if 6 months ago we were doing, let's say 80% leverage debt and that would cost us something like really cheap, less than 4%, which is really cheap for that high leverage money. Today, if you fast forward, our leverage has come down substantially. We're somewhere in the 60s in terms of loan to value or loan to cost. So going from 80 to 63, 65, 67, and the interest rate is obviously higher because the market is different. But that leverage change is really the most substantial change in the market. We're almost raising double the amount of equity for a given deal, right? If we're doing a $20 million deal, we used to maybe only need to raise $5 million. Now we almost have to raise $10 million for a $20 million deal. So the equity requirement has shot through the roof, and that is obviously driven by that lower leverage that we are getting from the lender, which is now mostly banks. And the reason why we're doing that is not because we want to add a bunch more work on our plate to go raise a ton more equity. We're doing that because we're trying to find the perfect mix of risk and return in our deals. And we're understanding that trying to get 80% leverage today is very difficult and very expensive. So it is rare to really find a deal to make it worth your while to get that higher leverage and higher cost interest rate. 6 months ago, the interest rate difference between a 60% leverage loan and an 80% leverage loan was negligible. So it was kind of a situation of, well, why not take the extra money, right? The market's doing well, and what's the worst that could happen? So people were more inclined to take on the higher leverage. Today, we think that a risk off posture, if you will, is more appropriate. And just from a price standpoint, it's really what is allowing us to make deals work. But the reason why I started talking about banks is because most banks are making floating rate loans, but they do have the ability to swap your rate. So you can go from a floating rate loan, and then through a swap product, which is a hedging product, you can swap your floating rate loan to a fixed rate loan through the bank. You can do it through a third party, but the bank will most often want to do it themselves, just so that they have control and they can actually book more revenue for themselves. Because a swap, if it's done right, the bank makes money when they provide you the swap. So that may seem like a no-brainer. Oh, well, why wouldn't you just swap your rate from floating to fixed if you don't want to take the floating rate, if you don't want to have the floating rate exposure? And you certainly can, but the thing you have to keep in mind is a swap comes with a prepayment penalty. So you don't just get to swap your rate for free. You now are locked into that fixed rate essentially. So if you are doing a 3-year loan, 5-year loan, or 7-year loan, and you choose to swap your floating rate loan for a fixed rate loan, well, now there's going to be a penalty if you want to exit sooner out of that loan. And so that's really, aside from essentially betting on interest rates, floating rate loans really are, the best part about them are the flexibility that they give you. Because when you have a floating rate loan, lenders have very minimal prepayment penalties. And the reason for that is because lenders don't really mind if you pay off their loan early if the loan is floating, because they can just take that money that you pay them off with and then make a new loan in the market at prevailing market rates. But on a fixed rate loan, lenders want call protection because they don't want to get paid off on a good loan and then have to then make a bad loan. And what I mean by good and bad is they don't want to, let's say a few years ago when interest rates were higher, originate a loan at 5% and then get paid off all of a sudden when rates go lower. And now they just got paid off this awesome loan that they were getting paid 5% interest on. And now they're in an environment where rates are 3% and they have to make a new loan at the lower rates. That hurts them. So they want to have protection against that. So when a lender's making fixed rate loans, they have protection most often, and that disincentivizes the borrower to pay off the loan early. We are really not fans of this because we are an opportunistic seller and we want to have that flexibility. So we will do certain things to avoid those onerous prepayment penalties, which mainly are yield maintenance and defeasance, which I'm sure many of you have heard before, but they are yield maintenance and defeasance are essentially the same thing, which is just this complicated calculation of your prepayment penalty. And it's based on how much of the loan there is remaining as well as what prevailing rates are. So it makes sense, right? If the prevailing rates have gone up, then the lender is more amenable to your paying off the loan because rates are higher. They can put that money back out to work in a good environment for them. But then that yield maintenance calculation works against you if rates go lower, and now the lender is less happy to be paid off. So the penalty gets bigger to offset that environment. So we try to avoid those situations at all costs. Even if we may think that we may be a long-term holder, we want to keep that flexibility. That is important to us. So that is something to keep in mind. Unfortunately, it's rare to find the perfect debt product where you get everything you want. There's usually pros and cons, and you have to decide what is the best fit for your business plan. So I think that is a pretty good place to stop on the debt side of things. Essentially talking about the different structures, different rationale for when you would use something, and what are the possibilities. If you have questions, again, please put them in the chat. If not, I'm probably just going to skip over to the equity side, unless we want to actually talk about a little bit more on the raising of debt, because we talked about the structuring. We didn't really talk about the raising, but let me get some activity in the chat to see if we want to do that or skip to the equity.
Yeah, let's talk about debt a little more. I mean, it seems like, and correct me if I'm wrong, like the banks and the lenders always have the upper hand no matter what. I mean, what strategies to use? And I know you talked about a little bit in terms of the structuring, but to try to get a little bit more of a handle on the advantage, if you can.
Yeah, no, that's actually a really good question. And I would say that it's really apparent and topical now, given everything that's happening, because really I'd say the debt market is the most challenging part of the business right now. Yes, finding deals is always difficult. Raising money is always difficult. The debt usually is not the hardest part, but I'd say right now it is just so hard to find good debt, and there's so much uncertainty, which makes it more difficult to have confidence in putting a new project under contract. And that uncertainty it's not 100% the lender's fault, right? If base rates, such as the 10-year US Treasury yield or SOFR, if those rates change substantially, there's not much a lender can do. They have to move with those base rates. So it's not like a lender's necessarily a villain if they have to increase their interest rate on you while you're under contract if the base rates have changed. But with that being said, you also want to avoid, if you can, it's not always in your control, a lender retrading you on terms, which right now is like I said, a dynamic, uncertain period of time where lenders are changing their minds seemingly daily. They want to make loans, they don't want to make loans. And unfortunately, as a borrower, you are at the mercy of their whims, kind of like Yona implied, which is not a very comfortable position you want to be in as a buyer if you are putting up, when you are putting up lots of hard money and you're going under contract and you have a fixed timeline to perform. So what do you do about all this? Unfortunately, it's really not that simple. You can't just, make the lender sign a contract, and lenders do really have all the power. So as cliche as this sounds, the best thing you can do is to build relationships. And so cliche, but it's so true. And it can really save you in times of need, because lenders are, they're not just people that work in dark rooms and crunch numbers. They're humans, and they make decisions not just on the numbers. They make decisions based on the people behind the numbers. And if you have a real relationship, they can make things happen for you, and they can potentially be less likely to, screw you at the last minute. So the idea is, instead of, while I do think it's important to build your network and have a stable of multiple lenders that you have relationships with, I also think it's valuable to really pick your relationships and try to build as much experience and track record with a lender, because the more business you do with a given lender, the more you carry weight, and the less likely they would be willing to damage the relationship in a way. So that is really powerful and something that it's hard. You can't build it overnight. And so if that's something, the best time to start building that is now, and developing those relationships and developing that credibility. So that way, even though you are at the mercy of the lender, they are at the mercy of their reputation. And eventually their reputation will catch up with them. So they do take it seriously, and they don't want to just go around being cavalier. They do have to provide good service, and this business is very small. So that I think is the important takeaway. Unfortunately, I can't think of anything that's more specific or actionable. But I guess the one thing I will add is, along the same lines, especially in an environment like today, taking risks as far as who you choose as your lender is really not the way to go. If you are contemplating, or if you're picking between two lenders and one of them is a known quantity and the other one maybe has a more attractive interest rate or more attractive terms, less fees, but they're not a known quantity and you've never worked with them before, you really should proceed with caution. And maybe now is not the time to be experimenting with new relationships as much as it can be helped. Obviously, you need to get deals done and you have to do what you have to do. But I think that is something worth considering as well. Trying to pick and choose the absolute best interest rate today and the absolute best terms may not be in your best interest. It may be more about, how do I pick the best relationship?
No, that's great. That's very helpful. Maybe it's a segue to what you're going to talk about, raising debt, but you're talking about finding lenders. Would you recommend, like, specifically shopping around lenders, or rather using experienced mortgage brokers that can do that for you?
Yeah, great question. And I'll definitely want to touch on that. And then also Douglas has a question in the chat really quick about fixed rate bridge. Like I said, there is some fixed rate bridge out there. It's quite rare, but banks are willing to do swaps, as I mentioned. So if that's something, if a fixed rate bridge loan is absolutely necessary for you, then the swap is a pretty much surefire way to get that done. You obviously want to check with the bank that they are open to a swap, and if they can do it, or if they're willing to let a third party do it. But that's a way to do that and avoid the floating rate loan with the rate cap structure. I didn't talk about rate caps, but that's a whole other topic. But to address the direct versus broker conversation, I think it's a similar answer to the one before. Is, I think today in this environment, it's not the time to be experimenting with your own relationships, with your own ability to make deals with lenders. And you really can benefit tremendously from the help of a mortgage broker that does this every day, and they're doing lots of loans and they have their finger on the pulse. I would say in a normal market, it's less critical, especially if you have a down the fairway deal. If you have just a very typical deal that's financeable all different ways and tons of lenders would love your deal, then it's not as critical to use a mortgage broker and get the absolute best terms, right? Because there's plenty of lenders out there and they'll make it happen. But in today's environment, that is not the case. The lending market is fractured and shrinking. And so having a good broker on your side, to basically, you're leveraging their relationship with the lenders, right? They have their relationship equity that they can leverage, and that can be extremely valuable to you in this environment. So that's something personally true for us. We have done lots of direct lender business where we have not used a broker and we've just had direct lender relationships. But in today's environment, we are doing every single deal with a mortgage broker right now.
What's the reason for that?
It's because of the uncertainty and difficulty with finding debt. You have to look high and low today. Even if your deal is just very traditional and it fits many criteria boxes, it's still hard to find lenders. It's not like 6 months ago where you could just kind of pick any lender and they would do the deal and they would be great terms. It's like I said, you have to search high and low today.
Gotcha. Okay. I appreciate that.
Great. So yeah, that's
Looks like
That's a-
Nathaniel has his hand up.
oh,
Nathaniel,
perfect.
did you want to ask a question?
Yeah, hey, so I had a quick question with regards to raising that capital, raising that money. So with regards to that, I understand with the mortgage, we would need to have some sort of down payment, correct?
Correct.
And from the books I'm reading and trying to educate myself, I see a lot of things that are talking about it's a possibility to get into real estate without money down through private money, right? And sort of the intersection I'm running on here is, let's say I find a great deal, it sort of seems difficult to say, hey, here's this great deal I found. Can I hop on board? Don't take it and run away from me.
Yeah, well, this is a good segue into the equity side of the of the deal structuring and raising. So, when someone's talking about buying real estate with no money down, it's usually talking about none of their money down, right? Because there's still 9 times out of 10 equity involved in the transaction. It just may not be personal equity. For the rare deal, if you can structure it so perfectly, there are opportunities to literally buy a deal with no money down, where maybe you can assume the seller's existing loan, and then the seller on top of that existing loan is willing to loan you the balance of the purchase price, and so you can get into the deal with no money at all. Or you can do something like a master lease with option to purchase, where you lease the property from the owner and you're responsible for paying their net operating income. So there are ways of getting into deals with literally no money down, but most commonly we're talking about raising other people's money and leveraging that capital for the down payment and the closing costs and for the renovation budget, et cetera. So that's certainly something that I can touch on a bit more as I kind of talk about structuring and raising equity on this in this next bit.
Yeah, absolutely.
All right, that sounds perfect.
Cool.
Thank you.
So let's jump into it. I mean, the equity side of things, structures are, it's kind of funny because you would think that debt is kind of straightforward. You line up your debt, it has an interest rate, has a loan to value, and plug and play. And you would think that equity would be more complex, that there would be all these different equity structures and things are more exciting. And while you can structure equity in a million ways, I really think that the best thing to do is to be consistent with your equity structure for the most part, especially if you're a syndicator and you're raising capital from your investors. And the reason why is I think it's a bit disjointed or not as coherent if 1 month you're raising money and here are the terms, and then another month you're raising money and the terms are different. I think providing a consistent deal structure to your investors lets them wrap their head around it. And really there's just, from my experience, from what I've seen as far as equity structures, the wackier they get, the more creative they get, really doesn't benefit investors. Whenever I see creativity in a deal structure, I usually don't see it being to the benefit of investors. So with that being said, sophisticated investors know that, and they can see through the fancy deal structure. So the more sophisticated investors like consistent and really just traditional deal structures. So I think that's kind of an interesting difference between kind of the debt side, where you can do different debt strategies and structures on every deal, and it's totally, it makes a lot of sense. But I think it doesn't on the equity side. So what is a traditional equity structure? Well, in our opinion, the most traditional and common equity structure that you'll see is a waterfall, where there's a preferred return component, which puts the investor first. So the investor is not guaranteed, but owed a minimum rate of return before profits are split with the sponsor. And so most commonly today, you'll see preferred returns anywhere from 7 to 10%, just depending on who the sponsor is and who the investor is and the deal profile. So let's say an 8% preferred return, that will like I said, entitle the investor to a minimum return of 8% before any other distributions are split with the sponsor. And the thing that is interesting about preferred returns is they're not all made the same. So the preferred return can be structured in a few different ways. And those ways are, it can be cumulative, it can be non-cumulative, which is pretty rare. It can be compounding, which is a good thing, but that is more rare. And it can also be subject to return of capital, which at that point makes it an IRR-based preferred return. So I need to unpack all that. So firstly, cumulative is pretty straightforward. And the idea is if you're offering your investors an 8% preferred return, and let's say you only distribute 4 in the first year, that 4% that they missed out in year 1 should, of course, accrue to year 2, right? And that should follow the investor. So the investor is owed that 4% still. Now, the next level would be compounding. And so it would be if only 4% is paid in year 1, that 4% that was not paid in year 1 should be not just accrued to the following pay period, but it should compound, meaning it earns interest on itself. So let's say, just to kind of put some numbers on it, let's say an investor invests $100,000 and they are entitled to an 8% preferred return, but only 4% is paid. Only $4,000 is paid in year 1. That means they have a $4,000 balance on their preferred return that they're owed. And that $4,000 will accrue to year 2 and then compound on itself at the preferred return rate of 8%. So your $4,000 that you weren't paid as the investor would earn an additional $320 of interest on itself. So in year 2, the sponsor now owes the investor $8,000 for that year's preferred return, $4,000 for the preferred return that they didn't pay in the previous year, and $320 of additional interest on the compounded rate. So that really is more favorable for investors, and it protects investors for the time value of their money. And the time value of money is the simple concept that money today is worth a lot more to me than money tomorrow. If I have to wait for the money, it's worth less to me. And the reason why it's worth less to me is due to inflation, it's due to risk, it's due to my opportunity cost. You know, if you give me that money today, I can go invest it and make an additional return. So investors should be compensated for their time. So that is kind of the more standard, more institutional preferred return style, which includes that compounding factor. And then the final, bell and whistle for the preferred return is what I mentioned last, was the return of capital. So this is a big differentiator across many deals. And I wouldn't say, while I do think the return of capital is, it certainly is superior and it's better for investors, I don't think it's a deal breaker. It's not like I'm saying don't invest in deals that don't have compounding preferred returns, and don't invest in deals that don't return your capital first before the promote. It's just things that you should take note of and weigh and evaluate when you're looking at different deal structures. Or if you're a sponsor, you should think about, in my opinion at least, how do I make this deal structure a selling point for my investors? I want to be able to look attractive for my investors, and so I can sell my structure as an attractive feature to the deal. So when I say return of capital included in the preferred return, what I mean by that is step number 1 is the preferred return. Then step number 2, after the preferred return has been met, is to return all the capital back to investors. And then after that, then there's typically a 70-30 split, for example, where 70% of the remaining distributions goes to investors and 30% goes to the sponsor. And that differs from, I would say the non-institutional preferred return, or also known as a cash flow promote. And a cash flow promote is a situation where step 1 is the preferred return. And then after that preferred return is met, any distributions thereafter can be split right away with the sponsor 70-30. So the initial investment doesn't have to be returned back to the investor before the profits are split. So obviously, when you return capital first, that's more downside risk protection to the investor, because the investor is essentially getting all their money back and a minimum return before any profit is shared. However, if a sponsor wants to be incentivized to hold a deal long term, then it can make more sense to have a cash flow promote. And the reason why is because the reality of the IRR-based preferred return, or where you have to return capital before the promote, the reality is the sponsor is not going to make any performance compensation until they sell. Most likely, that's 9 times out of 10 the reality for the deal. And the reason being is because logically, how is it possible to return all the investors' capital just through cash flow or even through a refi? You would have to have a very successful refi in order to successfully return all capital and hit the preferred return. That is a very cool situation, right? If you can, as a sponsor, pay the preferred return and then do a refi that's that cashes out the investors completely, it doesn't mean the investors are cashed out of the deal. They still maintain their ownership, but now their capital account has been reduced to 0. So they have no preferred return anymore because the preferred return is based on their capital invested. But if their invested capital is 0, the preferred return is effectively zeroed out. And that means every remaining dollar that's produced by the deal is split at the promote rate of, let's say, 70-30. So that's a really neat place to be, but the reality is it's very difficult to achieve. You have to create a ton of value and have a very successful refinance. So most of the time, as I mentioned, that promote is hit by the sponsor via a sale. And so what does that do? It incentivizes the sponsor to sell. And so if I'm a long-term investor, I may want to have a conversation with the sponsor and understand their deal structure and see if their deal structure incentivizes them to sell or to hold longer. Because something that you want to make sure from a deal structure is that, number one, it's appropriate, and the fees are appropriate, and the performance splits, the profit splits are fair. But the other thing is you want to make sure that the waterfall and the deal structure is set up in such a way that it incentivizes your goals. It helps you achieve your goals. And so if you are a long-term investor, a IRR-based preferred return where the sponsor is incentivized to sell may be actually not in alignment with your goals. So it's something very interesting to keep in mind. And I think, we personally do a cumulative and compounded preferred return that is subject to return of capital. So we've got all the bells and whistles, and we learn that structure through our institutional partners, which is, talking a little bit more about the raising side of things, where you have retail investors, family offices, institutional partners. All the structures that are common across those categories are different. But what's interesting about us is we learned kind of the more institutional way of doing deals through our institutional partners. And then we took those structures and we really applied it across the board. So we maintained the same reporting and deal structure, the preferred return, even across our general syndications. So, and I think that's benefited us a lot, and it's attracted, a more sophisticated investor base, as you could imagine. So something interesting to keep in mind, what kind of investors do you want to attract? Because the types of deals that you're doing and the type of deal structure that you have is going to influence what type of investors you have. I'm going to take a second to see. No, I don't see any new questions in the chat. But if you have any new questions, feel free to raise your hand or put it in the chat, as we mentioned before. But with that being said, let's jump into the raising side of things. So we're almost home. We covered the structuring side on a bit on the equity. Of course, I didn't cover it all. I mean, I touched on refis a bit, and there's a whole lot more that's coming out in my book. So I'm looking forward to that. But the basic structure, I think, is a very good place to be. If you don't know exactly what kind of deal structure you want to do or how you want to incentivize the sponsor, the most standard structure, I think, is the best way to go. I think it is not the best idea to stand out via your structure. And when I say stand out, I also mean in a good way, as well as obviously a bad way. All right, standing out in a bad way is obviously bad. If your fees are higher than most others and your profit split is higher than most, you're going to have a harder time raising capital from investors. But what's interesting is I also believe that if your fees and your profit split are actually better than most, I also think it's bad and you stand out also, and it also makes it harder to raise capital. And the reason for that is investors are used to a certain structure. And if they see a structure that is different, they're going to ask why. And they're going to wonder, well, is this sponsor offering discounted fees because the deal's not very good, or because they're not very good, or they're not experienced, or they don't have the confidence to raise capital compared to some other sponsors out there? So I think standing out on the good end of your deal structure is also a risk. So I think just being down the fairway and blending in with your deal structure is the best strategy. So I think that's pretty much everything on the topic of structuring for tonight. So let's cover quickly in a couple minutes the raising side. So of course, books have been written on this topic. Yeah, my friend Hunter Thompson wrote Raising Capital for Real Estate, which is an absolutely awesome book. So my book and tonight's discussion is not to try to take away from the comprehensive material that has already been put out on this topic. Obviously, there's careers that are spent on raising equity and investor relations. But let's see if I can think of anything particularly nuanced or interesting, or maybe something that you haven't heard before. So I think one of the more unique experiences that I have and that my company has is the fact that we have partners that are very diverse. We have investors that invest as small as $25,000, and we have investors that invest as large as $15 million. So with that diversity, as I mentioned before, you have investors that act and think very differently and have very different expectations about their investment with you. So, I think there's a good number of people out there that want to stick to one strategy and one group. For example, a sponsor may raise retail capital, and that's all they raise, meaning they have high net worth individuals that work in tech, they're doctors, lawyers, and that's their bread and butter. They have a network of 100, 200, 1,000 investors, and they raise fractional equity from that investor group. That's what we call that retail equity, or you can call that a syndication. And then there are other sponsors that really only do the institutional side of things. So they just do joint ventures with large equity partners, such as funds or family offices that are set up for this. And so they're doing joint ventures or JVs, which are typically done in a 90-10 split, which means the institutional equity partner puts up 90% of the capital, and the sponsor is responsible for 10% of the capital. And this isn't set in stone. JVs can be done at 95-5. They can be done at 99-1 or 80-20. So, but the idea is it's very different than a syndication, because in a joint venture, the capital partner has a lot more control, because if they're putting up 90% of the money, they want to have control of the deal. Whereas in a syndication, a person who's investing $100,000 out of 10 million can't reasonably expect to have control. So there's pros and cons, as with everything, between these types of capital sources. And the reason why I brought up both is I wanted to make kind of the general point, which I believe is it's very important to not neglect either one. I think both can be extremely valuable and serve a very good purpose in your business model. So to only focus on one limits you in the types of deals you can do, potentially how many deals you can do, and how profitable your deals are. Because of course, as you can expect, if you're going to get a single check from an investor for $10 million, they're not going to pay you the same fee structure as an investor who's only putting in $100,000. And that needs to be factored into your business model as well. One other point I wanted to make. I'll see if it comes back to me. But actually, yeah, this is a very interesting point. So I think this topic is becoming even more true in today's market, because more money is being raised through retail means than ever before. And that is because of technology and social media. What the things that are happening today is really remarkable and is really disrupting the private equity world. Before, if the only people buying $50 million deals, $100 million deals were funds and institutions that had large pools of capital. But now, because of the technology that can make bringing in hundreds and even thousands of investors into your deals possible, as well as social media to have the reach big enough to grow an investor network large enough for that, now you have syndicators who can actually compete with other people for $50 million deals, $100 million deals. And it's really amazing to see. And I think this trend will continue because it's a net positive on the world, not to be grandiose, but instead of investors investing into a fund, which then that fund hires an advisor, and then that advisor puts them into Blackstone, and then Blackstone is the joint venture partner of the sponsor. And that layer of fees crushes the end returns for the person putting in, the little piece of money. Whereas in a syndication, if you have a relationship with a sponsor, you can directly put your $100,000 in and get a better deal structure and get higher returns. So it's a net positive. It's disintermediating this capital formation process, and it's really putting a big strain on lower middle market private equity firms. Because if you today are sitting around as a $50 or $100 million private equity firm, and you only want to put 10% of your fund into a deal, that means you can only invest $5 to $10 million per deal. And if, as a sponsor, you may not be willing to accept the lower fees and the worst deal structure and give up control for just a $5 million investment or a $10 million investment even. So I think the world is changing, and it's very interesting to see. So to neglect, the retail side, I think is a mistake. But then at the same time, the institutional capital can be more flexible. It can be faster, and you can do deals that retail capital may not be willing to do. So I think both are really important, and I think that's growing in it's becoming more true over time. So we've got, I think we're going to the hour. We've got 5 minutes left.
Mm-hmm.
I think I'll pretty much end it there.
Yeah, we'll take some more questions. That was like drinking from a fire hose for the last 50 minutes or so. So I appreciate you sharing all that. But looks like Nathaniel had a question, and unless that hand was up from before.
Yeah, so going back to it, I was thinking about what you mentioned with raising equity, and going back to that point, suppose it was the case that an investor didn't have any sort of starting point, right? So if we look at people that are coming right out of college and entering the workforce, or most Americans in regards to their savings, they don't have even the amount of money to put down the down payment. So where would you go? Saying, again, let's just suppose it was the case that you're leasing, so you can't leverage anything. You're starting from, let's say, 10, 20,000. You don't have anywhere to go. How do you start?
So the good part is you don't necessarily need any money. The bad part is you never have enough of it. So when you have $10,000 to $20,000, you can find ways to leverage yourself into a partnership, or utilize a partner in the deal to make the initial deposit, to co-sign the loan, to help raise money. So all of those things are possible, not easy to do. And I can touch on that a little bit. But the reason why I say it's never enough is because when you have $10,000 to $20,000, those are your challenges. But then when you have, $100,000 or up to $1 million, you have similar challenges. You're struggling to make the initial deposits. Most earnest money deposits that we're seeing today are anywhere from $250,000 all the way up to $1 million. That puts a lot of strain on the sponsor to have to come up with those funds. And so, basically at every level, you're always feeling like you don't have enough money. So you always need to be willing and able to bring in partners to help you and grow the pie and develop that skill of not trying to do everything yourself. So I think you're asking the right question of, rather than trying to do everything yourself, it's okay, how do I look beyond and bring people in to make it happen? So, it's a simple answer, and it's not that helpful because it's so simple, but the reality is those partners are out there. People are out there that are willing to help you with an earnest money deposit, which is also called risk capital, right? We're putting capital at risk when we put a deal under contract because there's a risk that the deal doesn't close. So those are pursuit costs or risk capital. So there's partners out there that are willing to help with that. There's partners that are willing to help raise capital, and there's partners that are willing to co-sign on the debt, those are three major key components of doing your first deal. And it doesn't involve any money of yours changing hands necessarily, right? Obviously, you're gonna have to share a big chunk of the deal's equity and the fees. But I always say that if you can do your first deal for free, meaning you don't make any money from it, it's tremendously worth it. Even if you have to pay money to get your first deal done, it's so worth it. So how do you actually find all these partners? Doing stuff like this is really valuable, and basically networking and putting yourself in the right rooms for the opportunity to meet those relationships is the best use of your time. It's the best value. It's how you can advance to your goals the fastest. The faster that you, and the fastest way to amplify this path is actually by being a thought leader, which is very hard to do when you have not done a deal, right? It's kind of chicken or the egg. It's like, well, I want to be a thought leader. I want to share my message and in turn grow my network at a much faster rate, because if you're getting 100 people reading your newsletter or watching a video of yours or listening to your podcast, those are 100 people that could potentially be your partner, right? It's a lot more efficient than trying to go to your local meetup and bump into somebody. But like I said, it's chicken or the egg. It's hard to be a thought leader. So it's kind of, you have to be willing to put yourself out there in whatever way that it most resonates with you. And that's this concept, and it's 8 o'clock, but this concept is exactly why the interview podcast format is so powerful. And yes, it seems like everyone has a podcast. And yes, I know they do. There's a lot of podcasts out there, but it's such a powerful strategy where you as the host can interview guests and get to know them by them being on your show, and people get to know you because you're putting a show out there and you're arbitraging their expertise on your show. People are going to assume that you're the expert also because you're up there on the podcast having a conversation. So I'm not telling you to start a podcast, but thinking intentionally about networking and building up your credibility for the long term. If you're trying to raise money today, starting a podcast is not going to help you at all. If you need to raise money today, there's only one way to do that, and it's dialing for dollars. You just call everybody you know and you beg for money, and it'll work, but it's not very effective. And you don't want to do that. You want to dig the well before you're thirsty.
Right. Thank you.
Yeah.
And sorry, go ahead.
No, go for it.
Just really quickly on that note, with mention of networking, the biggest barrier I found to that was if we're networking with someone, it's starting from the point of you have something and here I am with, again, zero on my plate. So I'm thinking of how can I contribute to that relationship?
Yeah, everyone has, you may not have that angle today, but you will figure it out. And so that's why it's not an easy thing to do, but just essentially building, I keep hating to say building relationships, but you can do that before you necessarily are offering anything or trying to position yourself as, hey, I'm the guy that can help you find the deal or underwrite the deal or raise capital or whatever it is, or even like graphic design, for example. Getting involved any way you can. One of our most recent employees originally connected to us through Instagram, through following my Instagram content and messaging me here and there and just offering to work for us for free. And I accepted it and I said, hey, yeah, sure, we could use a little bit of help, but I can't let you do it for free. I need you to be serious and committed. So we're going to pay you a small stipend and build the relationship from there. And it's turning out to be a very mutually beneficial relationship. So it doesn't have to start with this idea of, hey, let's become 50-50 partners. Let's go all in together. It can be a small steps. And so the more irons you have in the fire, the better, right? If you have 100 relationships that can potentially blossom into something, it's a lot better than one.
All right. Got it. Thank you.
Awesome. Yeah, I mean, like I said before, this was like drinking from a fire hose, but it was awesome.
Well, I was nervous because I didn't have any presentation prepared, right? No slides. So it's hard to, not put
Rob,
people to
I
sleep.
do have a question for you, Rob.
Yeah.
When did you decide to write one of the best books in real estate ever? Because really, it was a missing gap in the marketplace. I wish when I tried to get started, I wish it was there. You did such a wonderful thing, and to that end, I must also compliment you on your use of sensitivity on your spreadsheet there. And I don't know how many people are using sensitivity or are familiar with it, but right now, sensitivity is like the time to have a sensitivity tab in your spreadsheet. I think now is a perfect example of why you need one and think about downside risk. And I just wanted to say congrats on that. I think you did a tremendous job.
Yeah, thank you so much for that. That's so great to hear. Yeah, I felt the same way as you did when learning the business. I was honestly shocked that a book like that didn't exist. And so it was the easiest book to write because, like I always say, the table of contents of that book was just simply the inputs in my spreadsheet. So just talking through our process, so easy, a lot easier to write than this current book, which is kind of, open-ended and all about debt and equity. So yeah, greatly appreciate that.
You bet.
Awesome. Yeah, I appreciate that. And excited to check out the new book because the first one obviously was game changing for thousands of people, literally, and especially given the current environment with lending and rates and uncertainty. The more strategies you have on your tool belt, the better.